Two men make the same decision on the same day. Both have $50,000 saved. Both earn about $60,000 a year. Both live in the same quiet American suburb where three-bedroom homes sit on 6,000 square foot lots. From the outside, their lives look identical. But what they do with that $50,000 will shape the next 20 years. The first man is Daniel. Daniel wires $50,000 as a down payment on a $320,000 duplex, a modest beige building with 2 garage doors and a small patch of grass. His mortgage is $1,760 a month. 2 weeks later, a tenant moves in and starts paying $2,200 in rent. Daniel drives past the property on his way to work. Every time he sees it, he thinks the same thing. I own that. At barbecues, his friends ask, "How's the rental going?" Daniel tells them the rent covers the mortgage and leaves a few $100s of profit each month. People nod. Real estate sounds serious. Responsible, adult. Daniel feels like he made the winning move. Across town lives Ryan. Ryan does something far less exciting. He opens a brokerage account and moves the same $50,000 into a total market index fund. No keys, no tenants, no building, just a number on a screen. Then he sets up an automatic transfer. $400 every month. The money quietly buys more shares. No one asks Ryan about it. There's nothing to see. On day one, Daniel looks like the clear winner. Daniel owns a building. Ryan owns a spreadsheet. One investment feels real. The other feels invisible. But over the next 20 years, something strange happens. Daniel works for his investment. Ryan waits for his. And when the math finally settles, the difference between how these choices feel and how they actually perform becomes impossible to ignore. Real estate wins the first impression. A building exists in the physical world. You can drive past it. You can touch the brick wall. You can hear the garage door open when a tenant pulls into the driveway. Every month a payment arrives. $2,200 in rent. That number feels powerful. It feels like income. It feels like proof the investment is working. But the number most people compare is the wrong number. They compare rent to stock returns, and rent is not profit. Rent is simply revenue. The difference between those two words is where most real estate math quietly breaks down. Because before Daniel keeps a single dollar of that rent, the property begins subtracting from it. First come the predictable costs. Property taxes. On a $320,000 duplex, that might be $3,800 a year. Insurance adds another $1,900. Already, more than $5,000 per year disappears before Daniel even thinks about maintenance. Then come the expenses landlords underestimate. Every physical building slowly wears out. Roofs age. Water heaters rust. Air conditioners fail in the middle of August when temperatures hit 95 degrees and tenants threaten to move out. A common rule in real estate is simple. Budget 1–2% of the property's value every year for maintenance. For Daniel's duplex, that means setting aside roughly $3,200 to $6,400 per year. Not optional, inevitable. Then there's vacancy. Even well-managed rental properties typically sit empty about 1 month per year. During that month, the mortgage still exists. The taxes still exist. The insurance still exists. But the rent disappears. One empty month costs Daniel $2,200. Suddenly, the clean story Daniel told his friends changes. That $440 monthly profit he mentioned at the barbecue, it exists mostly on paper. Because once the full costs are counted, taxes, insurance, repairs, vacancy, the real return looks very different. Meanwhile, Ryan's investment produces none of these stories. No tenants, no buildings, no rent checks, just a portfolio, quietly compounding in the background. Most months, Ryan logs in, sees the number move a little, and logs out again. Nothing dramatic happens. And that's exactly why most investors underestimate it. Because the biggest force in long-term investing rarely feels exciting. It feels slow. It feels boring. It feels invisible. But invisibility is where compounding does its best work. The debate people love to have is simple: real estate or stocks? But that question hides the real mechanism underneath both investments. Because the real comparison is not property versus the stock market. The real comparison is this: active leverage versus passive compounding. Two completely different engines for building wealth. Real estate is powered by leverage. Daniel did not use $50,000 to buy a $50,000 asset. He used $50,000 to control a $320,000 property. The bank provided the other $270,000. That leverage magnifies everything. If the property value rises 3–4% per year, Daniel benefits from the appreciation on the full $320,000 asset. Not just his original investment. That is the financial superpower of real estate. Small capital controlling a much larger asset. But leverage has a hidden cost. Because the moment you borrow money, the investment stops being passive. Debt creates obligations. Mortgage payments arrive every month. Tenants expect working appliances. Repairs cannot wait until next quarter. A broken furnace in January is not a theoretical problem. It is a $4,500 emergency that must be fixed immediately. Leverage accelerates wealth creation, but it also accelerates responsibility. Stocks operate on a completely different engine. Ryan's portfolio has no leverage. His $50,000 controls exactly $50,000 of assets. No bank, no mortgage, no property manager. At first, this seems weaker. There is no amplification, no borrowed money, no rent checks arriving each month. But something else is happening quietly underneath the surface. Compounding. Compounding behaves very differently from leverage. Leverage creates immediate scale. Compounding creates delayed acceleration. For the first few years, almost nothing appears to happen. The numbers move slowly. Sometimes the market even moves backward. But with every passing year, the gains begin generating gains of their own. Then those gains begin generating even larger gains. Eventually, the curve stops looking like a straight line. It begins to bend upward. And once that curve bends, it becomes extremely difficult to stop. This is why the comparison between real estate and stocks often confuses investors, because the timelines feel completely different. Real estate feels powerful immediately. You control a six-figure asset on day one. Compounding feels weak in the beginning. It hides its strength in the later years. And unless someone runs the full 10-year or 20-year math, they never see where the two paths actually meet. Start with Daniel's property. Purchase price: $320,000 duplex down payment, $50,000 loan, $270,000. Mortgage rate: 6.8% term, 30 years. That produces a monthly mortgage payment of roughly $1,760. The rent from the second unit is $2,200 per month. At first glance, the math looks excellent. $2,200 rent minus $1,760 mortgage. Daniel believes he's earning $440 per month. That's the number people repeat in real estate conversations. The cash flow number. But the moment you treat property like a business, the spreadsheet changes. First come the fixed costs. Property taxes, approximately $3,800 per year. Insurance, approximately $1,900 per year. That alone equals $5,700 annually, or about $475 per month. Already, the $440 monthly profit has disappeared. Then comes maintenance. Every building deteriorates, paint fades, appliances fail, roofs age under decades of weather. Professional property investors follow a simple rule. Reserve 1–2% of the property's value every year for maintenance. For a $320,000 property, that equals $3,200 to $6,400 annually. Even if Daniel lands near the lower end, that's another $260 per month, quietly leaving the equation. Next comes vacancy. No rental property stays occupied forever. Tenants move, leases expire. Some units sit empty between renters. Across the United States, the average rental property experiences roughly 1 month of vacancy per year. For Daniel, that means losing $2,200 in rent. The mortgage does not pause, neither do the taxes. Then come the surprises. A water heater replacement, $1,300. A broken HVAC system during a July heat wave, $6,500. A plumbing leak inside a bathroom wall, $1,800. None of these expenses arrive neatly spread across the year. They arrive suddenly. And they arrive exactly when the tenant expects the problem fixed immediately. By the time Daniel subtracts every real cost, taxes, insurance, maintenance, vacancy, and repairs, his $440 monthly profit often shrinks to something closer to $100 to $200 per month. Some years it disappears completely. The property may still build equity, but the clean cash flow story is far less impressive once the full math appears. Meanwhile, Ryan's investment follows a completely different pattern. Initial investment, $50,000 monthly contribution, $400. Average long-term market return assumption, 10% annually. After 10 years, Ryan's portfolio sits around $190,000. He has contributed roughly $50,000 initial, $48,000 in monthly deposits total contributions. $98,000. Everything above that is growth, but the real acceleration appears later. By year 20, Ryan's portfolio reaches approximately $520,000. His total contributions over those 20 years equal roughly $146,000. The remaining $374,000 comes purely from compounding. No tenants, no repairs, no midnight phone calls about broken pipes, just time. And this is where the comparison becomes interesting. Because after 2 decades, Daniel's real estate equity and Ryan's stock portfolio often end up in roughly the same financial range, around $500,000. But the path each investor traveled to reach that number looks completely different. One required leverage, labor, and risk concentration. The other required patience, automation, and tolerance for market volatility. And understanding that difference is where the real lesson begins. Once you strip away the stories, the bragging, and the screenshots people post online, the math leaves behind a few simple rules. Not motivational rules, operational rules. Rules that determine whether an investment actually builds wealth or simply creates the appearance of it. Rent is not profit. Stock gains are not guaranteed. The number people advertise is usually the number before reality subtracts its share. Always calculate the number after everything is included. Cars wear out, roofs age, appliances fail. The larger the asset, the stronger the maintenance pull. A $320,000 building quietly demands thousands of dollars a year just to remain functional. Ignore that gravity, and the return calculation becomes fiction. Every landlord eventually experiences empty units. Tenants move, leases expire. Sometimes people stop paying entirely. The professional investor assumes 1 empty month per year from the beginning. If the property performs better than that, it's a bonus. Debt increases scale. Daniel controlled $320,000 of property with $50,000 of cash. That leverage can accelerate wealth when prices rise, but it also magnifies stress when markets stall, repairs spike, or interest rates climb. Debt is a multiplier, not a guarantee. Ryan did not predict markets. He did not pick winning stocks. He simply allowed gains to generate more gains. The first few years feel slow, but over long periods, compounding behaves like gravity in reverse. It starts weak, then it becomes unstoppable. Every investment consumes something. Some consume money, others consume attention. Landlords answer late-night messages. They coordinate repairs. They show properties to potential tenants on Saturday mornings. Those hours are rarely included in the return calculation, but they are still part of the cost. Daniel owns 1 property in 1 zip code. Ryan owns thousands of companies across multiple industries. Both strategies can succeed, but the concentration risk is dramatically different. Ryan can sell his investment in seconds. Daniel may need months to sell his property. And selling real estate often involves agents, inspections, and closing costs that quietly remove 5–7% of the sale price. Liquidity has value, especially during emergencies. People admire visible assets, a duplex, a rental property, a new truck parked in the driveway. They rarely admire automated index fund contributions. But the investments that impress people are not always the investments that build wealth. 1-year returns are noise. 5-year returns are misleading. Real wealth decisions reveal themselves over decades. If an investment only looks good in a short spreadsheet, it probably isn't as strong as it appears. Humans trust what they can see. A building feels real. A tenant paying rent feels productive. A house sitting on a 6,000 square foot suburban lot feels like progress. A brokerage account does not. It's just numbers on a screen. And our brains are wired to value visible effort more than invisible growth. Real estate also creates constant decision pressure. Tenants text, repairs appear, vacancies create urgency. Every small problem demands attention. Over time, that pressure creates stress. More decisions, more interruptions, more cortisol. Index investing creates the opposite experience. Nothing happens most days. No tenants, no emergency repairs. Just a portfolio, moving quietly up and down with the market. That boredom is uncomfortable for many investors. But boredom is exactly the environment where compounding works best. Calculate the true cost of your current assets. Include maintenance, taxes, insurance, time spent managing them. Most investors have never run this number. Automate investing. Set a fixed transfer into Index funds, retirement accounts like a 401(k) or IRA. Automation removes decision fatigue. Stress test your investment strategy. Ask simple questions. What happens if the market drops 30%? What happens if a property sits empty 3 months? What happens if a $7,000 repair appears tomorrow? Real plans survive bad scenarios. Measure one overlooked metric: time spent per investment, because the best investment is not only the one that grows, it's the one that lets your life remain your own. Small money decisions compound into systems. 2 systems appear over time. Income rises, lifestyle expands. Bigger house, new SUV, more monthly payments. Eventually, income and expenses sit on top of each other. At that point, work stops being optional. It becomes survival. Income rises, lifestyle stays controlled. The gap between income and spending grows. Savings appear, investments grow. Compounding begins working in the background. 10 years later, the outcomes look completely different. One person owns more stuff. The other owns more freedom. Most people think wealth is ownership. A house, another property, a garage full of expensive things. But ownership often creates obligations. Mortgages, repairs, monthly payments. That isn't wealth. That's maintenance. Real wealth shows up in choices. The ability to leave a bad job. The ability to take time off when life demands it. The ability to decide how your time is spent. Because in the end, wealth is not the size of your assets. Wealth is the number of choices available to you. Optionality.